guys, welcome back. So yesterday was a very important day because it was the US jobs numbers that were out yesterday. And so for those of you that have been watching my videos, you know sort of what trades I'm in and a couple of trades I'm in, and sort of my currency positioning that I do have. So this is a bit of an update from that. So the jobs numbers, for those of you that didn't see it, was the estimates were 165,000 jobs for the month in March. It turned out to be 190, so it was a huge beat. So when you initially see these numbers come through, you think, oh wow, the economy is strong, numbers are growing, that means Jerome Powell should be raising rates. So therefore there should be a strength in the dollar, and it should be a potential decline in the equity market, because obviously if interest rates go up, equities go down. But to obviously make sure you analyze it properly, the average wage gain was an important number to look at. So wage gain was expected to be at 3.4%, and it was 3.2. So that was below the estimates. Now that is what determines whether US have inflation or not, right? Because obviously if there's wage gains in consumers, what's going to happen? They're going to go out, they're going to spend more money, so the economy will become more healthier, right? So because the numbers wasn't as expected, Jerome Powell now is in a perfect situation to say, look, I said I am not raising rates because the economy is slowing down and there's no signs of inflation. And now he can completely back up that opinion by saying, look, it's proof now, because the payrolls came out, we're creating more jobs, but the wages are not going up. So therefore, I don't have to raise rates. Now, this is bad for my shorts, right? I have shorts in the equity market, in the indices. So that's bad for that, because obviously now it reinforces the idea that he's not going to raise rates, which is completely fine, right? Because again, like I said to you in previous videos, the risk reward was good, which is why I took the shorts. So my stops are obviously at all-time highs, and we're still about 1% or 2% away from it, I believe. Yeah. So obviously I've still got a stop till there, so we've still got some space and some time. So there's nothing to worry about or stress about. But hey, those reports that just came through reinforce that potentially we could be reaching new highs. But obviously the currency trade that I did take, that's definitely now working in my favor, or will work in my favor, in the sense that I believe there'll be a weakening of the dollar this year, and those jobs numbers sort of reinforce that idea, because now he will not raise rates. He doesn't need to, and I'm sure in his next meeting, which is in the end of the month, by the way, just to keep yourselves an eye on that. And he can just reinforce the idea about, look, there's not that much wage gain and wage growth, so I do not need to raise rates as such. So it's a bit of a weird situation now. So in a sense, because the market's now obviously in momentum upwards, and they could be, you know, reaching all-time highs and new highs. So that trade, so for the people that have been long, you know, you could be potentially taking some gains out, or holding it until you sort of get to all-time highs. We've had a strong uproar in the equity market. So, you know, it's a very strong positive momentum chart. I still am short the indices. That's because, like I said, I've got to stop at the top, which I'm okay and happy with, because risk reward is good. Again, I'm hedged, so it doesn't really matter. Again, you shouldn't really get affected by, you know, any losses. It's part and parcel of the game. You make money, you lose money. And then with the dollar trade now, obviously something that I am short. If we just have a look back on this time horizon, so roughly we have had a top here at $97. Let's make this line thicker. So yeah, so that's the weekend. Obviously, if we get a breakout, we could be potentially reaching back to January 2017 levels, which is possible. But like I said, the Fed is dovish, so that could reinforce the idea of no rate hikes, and again, weakening of the dollar this year. So yeah, I thought I'd give you a bit of that update, because the jobs numbers was quite important yesterday. And for those of you that didn't obviously see that, it's now on your radar, hopefully. And I look forward to seeing you guys in the next video. Bye.